Hey, Brent Richardson here. I hope you'll join me today as we walk and talk about what's looking more and more like an impending mortgage renewal crisis in Canada. And maybe you've heard, but what's happening is mortgage renewal rates are doubling. So 5 years ago, rates were closer to 2% or even a bit lower. Now they're closer to 4%. So you've got a lot of Canadians renewing their mortgage, the rates doubling. And this is adding hundreds of dollars per month, in some cases, even thousands of dollars per month onto their mortgage. And so we're already starting to see this come through the data. There are 1.2 million mortgage renewals happening in Canada in 2025. And in the first 3 months of 2025, according to Equifax, the credit reporting agency, there's already been 1.4 million missed payments. And so that includes all credit cards and lines of credit, but it's heading up. And so are mortgage defaults. Okay, so the people are missing their mortgage payments. The financial situation is getting more difficult for a number of reasons. And I wanted to talk a little bit about this today and what solutions may be there too. So the first issue is Canadians, in many cases, are spending more than they earn. All right, so going into more and more debt. And traditionally, over the past 10 plus years, even longer, 15 plus years, it was relatively easy just to refinance the mortgage and consolidate the higher interest debt. And this would happen again and again. And the equity just kept going up. The home value just kept going up. And so this was able to happen. And so what we're seeing now is that the debt balances continue to rise, but home prices and home values are starting to fall. They've been falling for well over a year in some places in Canada. In some areas like GTA and GVA, they're down about 20%. Condos more, single detached maybe a bit less, but about 20%. And so this lifeline, this ongoing refinance strategy is coming to an end. And so we're starting to see defaults. We're adding higher rates into this. There's no more equity to do these refinances. And so the wall is being hit for many Canadians. And for every Canadian that's hitting up this coming up against this wall, hitting this wall, there are 5 others at least that, even though they're not in some dire financial situation, it's not a crisis necessarily, they're feeling it. And it's an increasing burden, an increasing hardship on many Canadians. And so this is just getting worse. And I talk to dozens of clients sometimes in a week, and most are okay. But what I'm hearing is that they're looking for strategies to help prevent a worsening of their situation, and also a strategy to really get ahead. And so there's 2 solutions to what we see happening here. This won't apply to everybody in the same way, not even close. But in a less than 10-minute YouTube video, we'll give it a shot here. So the first solution, if possible, right side the finances. So if there is debt, there's a credit line, high interest, or credit cards, get it consolidated one last time, or one time, hopefully. But the important thing is to increase your mortgage payment, maybe shorten the amortization, make it a bit less to account for the fact that you no longer have a credit card or line of credit payment. But the main thing is get into one lower interest rate and get your finances right-sided. For others, they might not have that option. It may be more of an aggressive debt repayment plan, which means making those debt payments as soon as you get paid and making higher debt payments so they're paid down. A lot more to this, but those are the main points. The second thing is to create an emergency fund. So 3 to 6 months of base salary, whatever form your income comes in, to have 3 to 6 months of this saved. If you make $10,000 per month as a family, that's the family income, then having a $30,000 emergency fund is highly recommended. And this really forms the base of a financial plan. So a financial plan, getting ahead financially, it's only as strong as its weakest link. And without an emergency fund, it means that not if, but when an unexpected financial event comes up, something unfortunate, it probably means going into debt. And this isn't the way to get ahead financially. It can derail a bigger financial plan. A retirement plan can easily be derailed if a good emergency fund is not in place. So these things are easier said than done. Saying save up 3 to 6 months, I mean, way easier said than done. It does involve sacrifice. It does involve trade-offs. And for some, that those trade-offs may be bigger, but the benefit you'll get from those trade-offs will be huge. Peace of mind is invaluable, and you'll gain that. You'll gain financial confidence, and the next time something comes up, hopefully it's not a job loss, but whether it's a car issue, a house issue, whatever comes up, again, it will, unfortunately, you'll be ready. And so this isn't going to derail your other goals. It's not going to keep you in debt. It's just the best thing to do from a financial planning perspective. As you go into retirement, an emergency fund helps too for other reasons. It can help save you on income tax. If you have a fixed income, you have a big purchase or a bigger expense, well, you can access that emergency fund from a TFSA, and it won't increase your tax rate. This is a lifelong financial strategy to have an emergency fund in place. And really, it's the main thing. After you've right-sided your finance, everything, after you've got no other debt and cash flow is as good as it's going to be, this is the first thing to work on. And so the best way to set one up is within a TFSA, a tax-free savings account, and with a high interest ETF. And once this is set up, you're going to have 75% of your finances figured out. Yeah, there's retirement planning, but if you can save up enough for an emergency fund, you already built that muscle that you'll need to ensure a good retirement. You've already kind of set yourself on the right track. So it's a good first thing to tackle. You'll never be one of those statistics that we're seeing, missed debt payments, mortgage defaults. You'll be in a whole other world of financial confidence and financial freedom with that emergency fund in place. So for every issue, and there are some big issues we're facing in Canada right now, there's also a solution. And I hope that you'll look into this emergency fund a bit more and really try to tackle it like you're going into battle, because that's what it is. That's what it takes in many cases to really get ahead. Given all the messaging, all the influences and pulls in life, it really takes a focus. You can do this on your own, definitely. You don't need a financial planner, but in many cases, a financial planner will help. I recommend a fee-only or advice-only financial planner that doesn't sell investments or life insurance, but that is just charging a fee to give you the best advice and to see you in the best position possible. That can help make things a lot easier as you progress through each step of your financial future. That's everything for today. I appreciate your watching, and I hope you have a wonderful day. Thank you.